Okay, you're saving for your retirement and you've heard of something called an IUL, but you're not sure what it actually is or whether it's too good to be true. Well, you're in the right place. Over the last decade, me and my team at Valoram Solutions have worked with thousands of retirees and pre-retirees across the United States, helping them transition from tax-deferred accounts like 401ks into more stable, tax-free income strategies. And the Index Universal Life Policy is one of the most misunderstood tools out there. Some think it's a scam. Others think it's only for the ultra wealthy. But when structured properly, it can give you stock market linked growth, zero downside risk, and tax-free access to income for life. In this video, we're going to break down exactly how IULs work, what's good, what's not, and whether it's even worth considering for your retirement plan. Well, I'm here with Lisa Williams. I'm going to go ahead and ask her a bunch of questions, and we're going to start with the basics, Lisa, right? First grade, okay? Making sure that it's very, very clear what this program is all about, and we're going to go back to the basics on just really basics about insurance in itself. So let's go through that. There are two main types of insurance, term and permanent, and people get that crossed up and mixed up all the time. Why don't you just take a first grader look at that to make sure our audience understands the differences?
Absolutely. So let's give the analogy between renting and owning. Term insurance is like renting. Obviously, we need a place to live. I think all of us would agree we need protection for our families while we're building our wealth. The key things with term is that they're temporary, right? They have a death benefit. There is no cash value, very important distinction there, right? And it's affordable, right? Pennies on the dollar. You can get a lot of insurance to cover your family.
Awesome, awesome.
Yeah.
And it's important to know the difference because they do have definite functions that will help you accomplish certain things.
Yeah.
And what I'm hearing from you is, hey man, if I'd rather rent a place than sleep on the street, right?
Absolutely.
You know, you have to have it. So
Absolutely.
it's not one is bad, it's how you use it. Okay?
Absolutely. Then you have, permanent insurance. It's like buying your first home. And that was so exciting when you got to do that, right? The benefits are, it's lifetime. It's for the rest of your life.
Yep.
Right? There is cash accumulation. It's like equity in your home. You're building equity in your policy, right? I love, love, love that there is affordable insurance like term. With permanent insurance, there is a higher cost, of course, right? California, you can't say this, but usually rent is cheaper than owning. You can't say that in California. With, permanent life insurance, yes, there is going to be a higher cost, but it's a wonderful long-term planning tool. And I really encourage people, think of our cell phones. This used to be, remember when we could just flip it open and make a call, and now we could do this meeting on our phones.
Yes.
It's a computer in our hand. So evaluate what is actually best for me in my situation right now.
Absolutely, absolutely. And that's why you need a professional to make sure that they go through line by line and see what are you actually trying to accomplish and which tool makes the most sense. Let's go through that. Now that we're talking about IULs, let's go through some basics on actually how it works. I'll let you break it down. We start with paying premiums. Why don't you take it from there?
Absolutely. Well, first of all, let's just be very clear. It is not whole life. Now, it is for your lifetime, but it's different than whole life. It has a different purpose, right? It is not in the stock market. I want to be very clear. It's not an investment.
Yes.
And it can complement your investments.
Yes.
Right? It's not a 401k though. We got to be very clear about that. I think there's a lot of hype out there that people try to replace their 401k. It's a great complement to what you might already be doing.
Absolutely.
Right?
Absolutely.
And it was created quite a while ago, back in like 87. It's been around for a while. It was around the same year as the Roth IRA.
Yes.
Right? Really, really wonderful tool. If we want to encourage people, it's, I believe, a great tool if you want some tax-free wealth in the future.
And again, just like any tool, it can be used incorrectly. Sometimes we get good news about it, we get bad news about it, and really it's about what makes the most sense for the client. I've seen it implemented in the wrong way and it causes devastation. But I've seen it implemented in the correct fashion as a complement, like you said, and it actually makes things better. That is so awesome.
Absolutely. Well, and think about like your cell phone, right? Products evolve, they get different, they change. We refinance our mortgages. Doesn't it make sense that sometimes we refinance our retirement?
Exactly.
Right?
Exactly. Okay, Lisa, now that we kind of understand the basics about this program, let's talk about how we fund it. Okay, let's talk about premiums, how it grows. Keep it at obviously a very, very basic level, but people need to understand that this thing is not as intricate as it is. Let's break it down basic for them.
Yeah, well, I mean, think about how people mostly are saving for retirement in the future right now. It's usually monthly, right? Sometimes they get bonuses. It's a big lump sum that they might put into their wealth building tool. There's no difference here. We could pay it monthly. We could pay it quarterly.
Wow.
You can pay it annually. I have some clients that do that.
A lot of flexibility.
Lots of flexibility. And it's important that one thing you realize is that there are larger costs in the beginning. Because think about it. You actually, God forbid, you contribute to this for 1 month and you pass away. Your family actually gets a crazy, crazy amount of money for one payment that's made, right?
And that's the death benefit.
That's the death benefit.
One of the benefits that it has.
Yeah, and that's an important part because it is, sometimes I think people look and, wow, it seems very expensive in the beginning. And that's intentional,
Of
right?
course. And it's my understanding too, you can speak on this, that there's no risk in the accumulation side. Talk about that.
Really key importance because I remember so vividly that 2008 to 2009 period. Every statement I was getting, these are when it was still paper statements. The balance just, right, we are dating ourselves. The balance just kept going down, right? Again, why this product complements what people are doing in their traditional wealth building is imagine instead of the volatility of the market, the roller coaster, you decide you're going to get on an escalator. You're going to put some of your money on an escalator, right? It's going to go up when the market goes up to a certain point, and when the market takes a tank, it's going to go sideways. So more of a staircase approach to your investing.
Absolutely. And what I'm hearing from you is you have volatility in your traditional qualified funds. This is a hedge to match the volatility with growth when the market's going in the wrong direction.
Absolutely. And think about the 401k, while it's a wonderful tool, it was developed back in the 70s when people needed a tax break. Taxes are lower than they've ever been in our lifetime now. Doesn't it make sense that maybe the tools that we're using should also change?
Absolutely.
Right?
Absolutely.
I think it's also a huge fallacy that we should put all our money that's for the future in a vehicle that we can't access till we're 59 and a half.
Well, I'm a big proponent that you shouldn't put all your money in one thing anyway.
Right.
My mom and your mom probably said the same thing. Don't put all your eggs in one basket. Drop that basket, it's all gone. So I'm hearing from you that all the gurus that are saying this is an alternative, it's not an alternative. It's a supplement and a complement. And that's what we at Valoram believe.
100%.
Perfect.
Absolutely.
Perfect.
So super quick, if you're watching this and thinking, okay, this is actually starting to make some sense, then you'll probably want to know if this kind of strategy would even work for your situation. I put together a quick 60-second form, which helps you see if you'd even qualify for an IUL strategy based on your age, your income, and your goals. It takes 60 seconds, so after this video is complete, click the first link in the description and fill out the short form.
Okay, now let's talk really about the mechanics. How does the actual growth work?
Okay, yeah. Well, let's talk about the first part, the index linking. I describe it, instead of being actively in, let's say, the S&P 500. Most people are familiar with that. You're mirroring the market, right? So you think about the benefits of that. Everyone is familiar with the S&P 500. You can still participate in that same thing you're familiar with. However, what comes up is index performance versus actual investment.
All right, Lisa, well, the big question is, how does this actually really work when it comes to the mechanics? Why don't you touch base on that?
Okay, so first of all, you're going to think about cash value is in the indexed account. Here's what happens. If the market goes up, your account earns interest up to a cap. If the market crashes, you don't lose a dime. You have a floor, usually 0%. So if your cap is 10%, let's say, and the market returns 12, you'll get 10. If the market drops 20%, you earn 0, not negative 20%. This system gives you growth with protection. Why does this matter? Because it removes the emotional roller coaster of investing. You get consistent growth without the downside volatility.
That's amazing. That's amazing. And so now we got to ask, how is this even possible? Because it doesn't work like that in other formats. Touch on that.
Well, think about, Alvin, just having options, right? Imagine you want to buy a house, but you don't want to commit yet. So you pay a small fee to lock in the price for 12 months. If the value of the house goes up, you exercise your option and you buy it cheap. If the value goes down, you walk away. You only lose the small fee. That's how insurance companies use your interest. They buy options on the market, not the stocks themselves. And if the market rises, the option pays out and they credit your policy. If the market crashes, the option expires worthless, but your money was never invested in the market, so it doesn't lose value. This is the core engine behind the IUL.
And what I found is insurance companies never make bad bets. They are always making money. I read somewhere that over 70% of all properties in major cities are owned by insurance-based companies. So they're probably making good decisions and making money. People always ask too, like, well, if they're giving us all the gain, how is that the case? Well, they're not, right? They're giving us up to a certain point, they get to keep the rest for giving us a floor. Does that sound right?
Absolutely. So let's say your cash value is $10,000. You can put it into a fixed account and earn 3% annually, nice and steady. Or if you choose the indexed account, market rises, let's say 8%, and your cap is 10, you earn 8.
Yes.
Right? Market crashes 15%, you earn 0, not negative 15%.
That's awesome.
And each year they use a portion of your expected interest to buy options. If the options make money, they credit you. If they don't, you don't lose. You just earn 0 that year. And your principal stays safe. And your previous gains are locked in.
So now let's talk about structure, because people don't really understand the structure. I think it's important for people to get to understand, how does this thing layer itself so that they know and can trust. Like, if I don't understand how something works, I don't want to participate in it. So let's talk a little bit about that.
Absolutely. And this is such an important question because not all IULs are created equal, right? We know this. The way your policy is structured determines how effective it will be. There are 2 main approaches: death benefit focused, which includes higher insurance costs, more money going toward coverage, and less cash value growth.
And we know that that's important sometimes.
Absolutely.
Right? It's
100%.
important sometimes.
Absolutely. Okay. The second one is cash value focused, which quite frankly is what most people want.
Correct.
This includes typically lower death benefit. More money goes into growing your cash, and it's used for tax-free retirement income. This is what most people mean when they say properly structured IUL. It's about minimizing insurance costs and maximizing growth.
Awesome. Awesome. So now, people ask me all the time, I heard that my money's stuck in a 401k, which we know it is, typically until age 59 and a half, but that I have access in my IUL. Let's talk a little bit about that.
One of my favorite features of this, let's talk about the 2 main ways, because there are a couple of different ways, but 2 primary ways. Withdrawals, number 1, you take out cash, but anything above what you've contributed is taxable. Important note.
Yep.
So this method isn't used very often, right? Number 2 is the most common, which is policy loans.
I'm going to pause for a second.
Yes.
Because this is where the rich, this is how they get away with no taxes, right?
Absolutely.
I want to make sure everybody understands this. Take notes right now. If you want to know how these guys like Elon and all these business owners don't pay any taxes, they use tax-effective loans. Go ahead.
I heard once that the average billionaire is paying about 8% in taxes.
They understand how the game's played.
In this
That's
market.
right.
So let's talk about policy loans. This is the magic. You borrow against your cash value, tax-free. That's pretty magical.
Yep.
The money continues to grow inside the policy, and you pay yourself back on your own schedule, or not at all, by the way. There is that option. If you never pay it back, the loan simply gets deducted from your death benefit. And there are two types of loans. There's fixed loans, which are simple and predictable. And then there's variable or index loans. And these have the potential for arbitrage. Very, very important if your policy earns more than the loan interest.
Awesome. Now, it can't be all unicorns and butterflies. There has to be some downturn potential. Let's just be honest with everybody, because we're all about, right? We're a kingdom company. It's all about, we're not about half-truths, because those are full lies. Let's go ahead and make sure we disclose everything on how potentially, when structured incorrectly, or when using the wrong product for a certain problem, how could it go bad?
Absolutely. This is so crucial. And one of the reasons we recommend doing policy reviews, right? First of all, they cost more than term life insurance. Very important. And you won't see huge growth in flat markets, right? You also have caps and rates that can potentially change. So important to watch that. Returns are not guaranteed. And if structured poorly, they can actually underperform. So remember, this is a long-term strategy. If you want overnight results or get rich quick returns, this is not for you, right? But if you're disciplined, if you want tax-free income, protection from market loss, and flexibility, then IULs can be an amazing tool.
And one thing that we've done as a company is made sure that we've produced a selection of exclusive programs that have, dare I say, guarantees, that have certain distribution factors that do not fluctuate, so that we can beat the factor of volatility. Because if you go back to it, one thing that you said was, hey, you could lose money, and so can a 401k.
Yeah.
You know what I mean? Things can change, rates can change, as they do in the market. The IUL, when you pick the right one and structure it properly, what I'm hearing from you, Lisa, is it definitely hedges against this bucking bronco in your retirement. Does that make sense?
Absolutely. Doesn't it make sense to have these different buckets that mitigate risk at least?
Now, let's jump right in. Now, who is this for? You know, who's the proper candidate? And they can say, oh, that's me. Who is this for?
So if you are a long-term thinker, this product is for you. If you are disciplined, right, in your wealth building.
Yes.
You realize you're running a marathon. You're not running a sprint. This product could be a good complement to what you're doing. I think it's also important to think about how much do I personally value protection versus growth, because there's different tools to solve each problem, right? And I think it's also really, really wonderful for people that are very forward thinkers. They're planners.
Yeah.
They don't have a financial junk drawer. They really have a plan.
Yep.
Right? And they're looking at different tools that can complement their plan.
Absolutely. And now, on the flip side, who isn't it for?
Yeah, it is absolutely not for the get-rich-quick, short-term investor, right? If you're saving for a new car, this probably isn't the plan for you. That should be in another bucket.
Too short of a horizon.
Too short of horizon. If you want access to cash quickly, fast liquidity, this is not for you, right? And I think it's also important that you recognize you should be at least open to structure and be willing to commit to that structure, right?
Perfect. Okay, so if you're still asking, what is an indexed universal life policy? Well, it's a smart, structured financial tool that, when set up correctly, can give you long-term growth, downside protection, and tax-free income in retirement. Is this video helped make things clearer? Make sure to like and subscribe so you don't miss future breakdowns exactly like this. And if you're wondering whether an IUL is right for you, click the first link in the description to see if you qualify. It takes less than 60 seconds and you'll get access to a free, customized analysis. Thanks for watching, and we will see you in the next one.